Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracey, and this week I'm joined by Zacks Chief Equity Strategist and an economist, John Blank, to fill us in, as he always does, about what's going on in the economy out there. And, are we going into a recession? Now, we've had this conversation many, many times over the years, it seems like. And the last time I had to go back and look, John, about the last time that I had you on, and it was March 29th, 2023. So it has been a while. And that's kind of because we aren't in a recession yet. So I was like, well, why have John come back on to say the same old stuff we've been talking about? But now that the Fed themselves is apparently saying they don't foresee a recession, I thought this is a good time to have you come back on so we can talk again about what to look for, where we are, and why everybody is getting it so wrong. So welcome back.
Thanks, Tracey.
So I was looking at some of the employment data before we went on here for the podcast, because I know you always tell us to look at the employment data. And I looked at the June number. It was at 3.6. It did jump up to 3.7 in May, came back down 3.6. The weekly initial claims, I like to look at the claims that come out every week. Those last week were at 221,000. That was down. I looked at the 4-week moving average. That's down. It's at 233,750. And I remember you always say we have to have over 300,000 on the weekly claims to even be thinking about, recession is imminent. The continuing claims looked good. That's down. The 4-week moving average there is down about 10,000 from the prior week to 1,719,000. So what's happening? Why is this so good?
Yeah, I'll throw out the non-farm payrolls that are core to the whole story here. So my addition to this will be down at the bottom of this employment situation summary by the BLS. They'll say the change in non-farm payroll. April was revised down by 77,000 to 217,000. Change in May was revised down 33,000 from 339 to 306. So we've got a recent one that will be revised at 209, and we have two in the past now that will be 217 and 306. So I'm just going to push that back to you and say, are we in a recession on those numbers?
No.
No. The answer is no. Yeah, I mean, why Tracey and I do this, it's fascinating to just speak to the facts that come from the government and understand signal versus noise. We want the revised facts. We want to actually be somewhat tardy in calling recessions. One of the big problems we've had this time around is the leading indicators, which are typically a function of the conference boards, and they use yield curve inversion as a major leading indicator, have been negative for 15 months. So this has gotten all of the prescient, black swan, great calls turned people out there. There's a huge industry of people who want to be predicting things as opposed to just doing the more humble thing, which is what we're doing, updating people on the coincident indicators, which are the labor market indicators, which are very strong and very stable. So not only are they strong, Tracey, but they are very stable. The 3.2 to 3.7 range on the household unemployment rate has been in place since March of last year. So now we're in 16 months of stable sideways employment at a high level. So no momentum one way or the other than very strong and stable unemployment. We all know the story about job openings and job quits being quite strong, and there's a lot of demand for labor, and it's not really dissipating. So the basic point here is, after a COVID pandemic, you have a set of structural issues in the economy that are favorable to stable growth. And this has been lost because an exit from a COVID pandemic has been matriculated into a recession call. There's no cycle here other than getting out of a COVID pandemic. There is no historical analogy that's been that should be drawn to all the other cycles we've seen over the last 6 or 8 times up and down the cycle. So this has really confused a lot of people. Yeah, well, once in century event. It's a COVID pandemic. You shut down, through policy means the economy. The quote cycle language is worthless.
Okay, so those people who go back and look at, 2008 and look at the unemployment, like what it was doing then, and then suddenly there was like this big spike up and that could happen this time. Those people they're completely wrong. They're just out of there.
Yeah, that's it. I mean, what happened this time, if you're worried about housing, well, we had mortgage-backed security buying and treasury bond buying on a monthly basis throughout the pandemic, which kept, the average fixed mortgage rate in the United States now, the 30-year fixed mortgage rate for most people is less than 3%. So they locked in low mortgage rates on houses. And then, of course, we know the story that we're now at a Fed funds rate of 5.25%, which should translate into a 7 to 7.5% 30-year fixed rate mortgage. So you say, wow, that should slow down the housing industry. Well, no, if you have a 3% mortgage and you're going to swap into a 7.5% mortgage, you got to think really hard about that. Probably not do that and probably stay with your house. So now we got a lot of termite inspections, remodeling, and people sitting on their houses. So there's a low inventory housing situation because everybody doesn't want to swap out that low rate mortgage. They aren't going to see it again. So what's happening is that's holding prices up, and we're not having a collapse in prices. In fact, we're having the opposite because people aren't selling their houses. So the real issue here is, when does that string play out? And I have to capitulate and sell my house. Well, I have to capitulate when I have to move for a job, or I lose my job. So these are the two things. We've now created a kind of immobility in the economy, right? Because people don't want to move out of their houses. But at the same time, we now have remote working. So if Tracey Reineck wants to get a job with a different group in New York, she can stay remote and work in Chicago and not sell her house. So the other thing that's interesting here, in a post-COVID environment, the worry about mobility is dropping because you can work remotely. So again, a lot of these things, you start working through the logic like I just did in a post-COVID environment, not a broad, generalized cyclical environment. You get answers that are fairly sanguine and say, no, it's not gonna roll over. It's not gonna happen. Not for a while. I mean, in general, again, as an average, the other thing that's been really wrong here about these rate hikes is, yes, they were rapid, very rapid, because the Fed got behind the curve basically a year, but they got up. So when a rate cycle starts, it's on average, and an average is an average, people. It's not going to happen. It's what you got to use as a thought experiment. It's 25 months till anything. So we start 17 months ago. An average effect is not going to hit us till next summer, right? So the earliest we can actually get a sanguine idea of a slowdown from the rate structure itself is next summer, and that is not factoring in that next summer will be right in front of an election. It'll be right in turning with probably a much lower course PCE by a point from now. If it just even goes down a tenth of a point or 0.2 of a point month on month, it's going to be down. So inflation will be lower. There will be an election, and the government has already locked in infrastructure spending on a rider in that bill till the end of next year because they don't want to have spending drop in front of the election. So to have that average work out for you in front of this election with those circumstances on fiscal policy, with this circumstance amount of better CPI or core PCE, which will lower the potential Fed funds rate, that's not going to cause a recession next year. So I think, if you start doing the thinking like I'm doing here, you say when. The when is 2025. That's when.
Okay, that was going to be my next question.
That's the answer I get just sitting here talking to you. And I've written this in commentary within the company on my own portfolio management. It's like, look, after the election, if it goes Biden's way, after we get some slowdown that gets irregular and people start really unloading houses in a massive way, there could be a slowdown in 2025. I don't think people should just throw this idea of a recession out.
Okay.
But, I on the investment committee at Zacks Investment Management, I made this point, and Mitch agrees with me on this one, is the other thing we can have is a look through a recession that's super moderate, and basically the market doesn't care. The other thing is all the bears can be right, and your stocks don't care.
Yeah, right. Because a lot of the separate segments of the economy have already been in a recession. We were just
Right.
talking about housing. That was in a recession last year for sure. And even the beginning part of this year. But now the National Association of Realtors, their economist has declared the housing recession is over. He's just declared that. We have manufacturing in recession, but it's such a small percentage of the overall economy. And even manufacturing is maybe going to start to turn around here with all the spending on the clean energy that's in the bills you mentioned, the CHIPS Act, that's all going to be in manufacturing coming into next year. So that's going to be a stimulus. So what is it? It would have to be tech or something that, you know, is the stimulus to slow, but we had that last year too. And into the beginning of this year, where we had a lot of layoffs. Some companies that were a little too speculative did shut down. I had some friends who were at several of those places. They've already gotten new jobs in other tech companies. So what do you think could be the catalyst? Let's be bearish and say that there could.
Yeah, all it has to be is the housing market, right? You have extreme unaffordability, which is restricting the amount of spending away from housing. The buy downs and people being able to delay this thing out plays out. They starts to build, and then you get in a market in your neighborhood where everybody unloaded their house and inventories are very high, right? You get a huge inventory in an area of the country. Let's say Phoenix. Climate change. Suddenly, there's a huge inventory of houses there, and you're stuck. You want to unload it too, but you waited too long, and everybody's out there cutting price. And then all of a sudden that drops all the realtors out of Phoenix, that drops the construction out of Phoenix, and then it starts to multiply and spread because that is when you get a situation where you thought your own individual decision is the only thing that mattered, and it turned out, no, you're in this basin with all these inventory numbers, and that inventory number is critically changed, and you didn't catch the turn. So all the issues that people have tabled about the economy are relevant. They're just not relevant in any time frame people have been pushing. Because for whatever reason, the speed of the rapid rate hiking convinced the economist community that the economy was going to turn down in equal measure very rapidly. And that logic, it's not even good economic logic with respect to 25 months of history. It was plainly wrong. I think a lot of people took the leading indicators and they just said, hey, look, the leading indicators are down. And that's always the case, and it always happens. And we've done this with PMIs that have been wrong because purchasing managers are for purchasing managers, and leading indicators are not, they're just leading indicators. They're not religion, right? It's not like it's going to happen, right?
Right.
And this is really a problem for people when something is just to start a reference point, and that's it. And it's not this, thing that we have to, put on the books and say it's going to happen and stamp it and say it's going to go. It's going to always happen this way. It's not the case. There was plenty of evidence on the 6 or 7 indicators that are in the NBER definition of a recession or expansion that were all really positive. The only thing, as you've pointed out, is there is a slowdown in manufacturing output, but that's 15% of the U.S. economy. And by the way, that's after a spike in output during the COVID pandemic. So it's kind of a rationalization, right? And again, the other problem here is oftentimes when people see any weakness, they don't just say, oh, it's rolling over from a high point to a low point. The PMIs are down. Yeah, well, they were at 60 for like 16 months, which is super high. So if you bought a lot of stuff for a while, and then you don't need to buy a lot of stuff. And that's really the answer, right? So we've gotten a lot of people talking their book. We've got a partisan political environment that does not want to give credit to the administration for the economy. And then we've got these amateurs in my profession who are overselling a story and trying to publish monthly periodicals about recessions that is simply way off base.
Yeah. So what do you think about China and what's going on over there being a catalyst. So you were just talking about manufacturing and, the huge demand we saw during COVID. A lot of it was in China. They had to manufacture the stuff, put it on the boats, ship it to us because we wanted the workout weights and the, outdoor furniture or whatever. And now that's gone away over there. They don't have the demand either anymore. So they're slowed on the manufacturing side. Could China be a catalyst if they were to go into a more severe slowdown, which it's kind of looking like is a possibility, perhaps? Nobody knows. Or is China we shouldn't even be discussing?
Yeah, I mean, again, this is what's called large economies, right? There are large economies and small economies. When you have a large economy, and the two largest are China and the U.S., the rest of the world doesn't matter a whole heck of a lot. It's just another one of those things where the weighting is just not enough. I mean, you say, okay, yeah, we got a $500 billion trade deficit with China. Okay, well, we have a $27 trillion economy, so that's 2.5% or even less, 2%. 2% is not going to roll over anything, even if it gets a half, you goes 50% down. Just not going to happen. So again, this is the problem. And people are saying why I get back to payrolls is my summary statistic, meaning it's summarizing all of the headwinds and the tailwinds. Because there's an industry, there is a massive industry to produce documents and research and update people and call turns. And basically, you need as an investor to learn the summary statistic and do what we do with every single one of these things, which is just recite the data. Just recite all the data and then just say, okay, there's the data. That's reality. That's the signal. That's not the noise. And yeah, there's simply no recession in sight, period. And then just stay vigilant, and get out of this calling turn thing. So the idea that we're saying today there is no recession and no sign of a recession does not mean there'll not be one. We just think by saying now that the recession somewhere possible out 2 years from now is completely worthless.
Right.
Right? It's totally worthless. I can sit here and be bearish for 2 years and then finally get it right and give you the worst advice for 2 years but exonerate myself.
Right.
So we need to say, look, this is a job for you to do, not for me to do, right? For you to do. Look, get this data, read the data, and learn to say, when the data does what it does, it is what it is. It's not what you want it to be. Don't talk to the data. Don't talk bearishness to the data. Don't talk bullishness to the data. See, at one point, we're going to do one of these shows, and it's going to be one of 25 shows because there's very few downturns. And one of 25 shows will be, yeah, the non-farm payroll's 50. It got revised down minus 60, and the next month is minus 10. Then we have an issue, right?
Yeah.
But, non-farm payrolls that even drift down into the 150s and 120s in the next 6 months at this point of the recycle of expansion should be expected. And that's not going to be enough to convince me to think it's all going over. Again, we get negative prints or zero prints on a revised basis. We have to say, done. We're here. We're in a place. And that's it. But otherwise, we just simply shouldn't create that fear and speculation because, by the way, how many people sold out in October and missed a 25 or 35% run in 8 months because of these bears? That was incredibly bad advice.
Right? Yeah, I saw someone on Twitter, he's in real estate, but he did admit that he sold out, not even in October. He waited until May because we did have the strong rally to open the year, but he sold in May and went away, like the old saying says. And he has regretted it. He admitted it. He's like, I missed out. This was a couple of weeks ago even. He said he missed out on 10%. It's probably even a little bit more now. So yeah, you can't be trying to time it, based on people picking like when the recession is going to start. Also, because as we know, stocks, price it in well ahead of time usually, and then are already rallying even while we're still in a recession. So that's a dumb way to pick stocks. But let's talk about stocks for a minute. Last time when you were on, we were in the banking crisis. So we talked a little bit about the banks, that you did think, it was okay to buy some of the big banks at that time and all that. Those have mostly rallied and nobody's that concerned about the banks anymore, at least right now. So that's a good sign. But what areas should we be looking in for stocks, as we head into the fall? That's always kind of a dreaded period. We've had this massive rally, and the S&P 500 I have is trading at 21.4 times forward earnings. So where should we be now?
Yeah, I mean, heat map at Zacks telling you any construction area.
I was going to ask about that.
Yeah, construction, home construction, any commercial construction that is showing a strong pulse. Obviously, the office market is dead, but those people who are going to rehab these offices are going to be the business. So even that whole nobody's in the office thing, that's entirely true. By the way, we have overpriced housing, so the condo conversion crowd in the real estate business is going to lap up all these groups and put house. Downtown LA is empty. Yeah, well, great. How many 50, 60-story houses? Well, that's perfect, right? So this is the problem. It's like a timing thing. If I can get all those buildings rehabbed and put in balconies and create nicer frameworks and get rid of them, I can create 50, 100,000 units in downtown LA, which will then drive retail, which will not create a recession, and we'll get rid of a ghost-like environment in Los Angeles. So how long does it take? When does it happen? What are the lags and leagues? How are the staggered contracts with these things? How long do the banks let this play out? Well, see, this is the problem with all these things. You got to go back to the summary indicator because nobody really knows how it plays out in the aggregate because you're always going to not want to see or not weight something properly, right? The basic problem of reading anything is, you read it. Oh, my God, office things are tanking. Yes, they are. So how much of it is going to happen and when is it going to happen and how many positive things are you ignoring in the face of that, right? That's a very difficult challenge for most people, right?
Yeah. So if we wanted to get on the construction side and maybe not even on like the downtown office stuff, which could happen in the next couple of years, we do have that large infrastructure bill and they are going to be building, charging stations and all this other stuff along with that, all the bridges and all that. Should it be in like stocks like United Rentals, ticker URI, or HERC, which is HRI? They also do the same equipment rentals, or like a company like Mastech, ticker MTZ. I think they haven't reported earnings yet, but it's coming up soon. I think Tudor Perini, TPC, I think is that ticker. Those are all like on the actual construction side, either like in some kind of, the equipment or things that are going to be deployed to go out there to build all this stuff. Or should it be like home builders? Those have rallied huge. Some are at all-time highs. People get a little nervous about buying at all-time highs, even if with low valuations or, solid fundamentals. So like DR Horton, DHI is the ticker there. That's at all-time highs. So should it be all of these things? These are all cheap, by the way, on a PE basis. These are all cheap.
Yeah. I mean, I did some, on YouTube, I did some industrial videos and they have the PowerPoints of the ETFs. So go to the ETFs on the industrial videos. There's 8 or 10 of those in there and just cherry pick the top 10 holdings. One we've talked about before is AIRR, which is the Richard Bernstein American Industrial Renaissance, which is, some mid-cap holdings, names you don't know about. Last time we talked about this, it's up 15% since then. Again, it's not doing NASDAQ stuff, but if you made in 8 months 15%, you did well. And you're probably not in an overpriced environment. The thing's going to keep going. It's very steady. So cherry pick major ETFs that have 4 and 5 star ratings and just then run them through the Zacks system and make sure you're getting, earnings surprises pretty serial. You're getting upgrades to annual earnings and just kind of play the game of if it's strong in the fundamentals, then you've got a play that's working in the way you think it should.
What was the ticker on that ETF again? I forget what that
AIRR.
AIRR. Okay. I was missing an R on there and I was like, that's not it. That was I remember that from last time when we talked about that. That was a good call. And it does seem like those stocks, do have momentum here. It's not all about tech, obviously. So what about, on the flip side of the construction, you're going to need some commodities with that. You're going to need copper, for sure. And, steel and all this other stuff. What about commodities plays? That's always a little trickier, I feel.
Yeah, again, I've did some materials videos on YouTube, and they have materials ETFs. The one thing I would tell you about materials ETFs is there's process materials, and then there's all kinds of the junkyard ETFs or materials that have all kinds of stuff you have no idea what's in it. The process material things are probably interesting, and I think particularly battery materials and things that are related to broad use of things in batteries is going to work, and there's ETFs in there to cherry pick. But again, you're coming to this late in that game, and you have to wait on pullbacks for that story. So what I generally like is things like international paper, which is everybody's giving up on the packaged goods because of the goods environment, but that's going to turn around here. You're going to want to buy them when everybody's giving up on them. So there's a lot of packaging and packaged goods and container goods that I like now. I think that's when you want to buy them now, when everybody's decided the manufacturing is going to pieces and we're never going to come back to it. That's perfect.
Right. And some of the problems with, I know, the packaging companies has been, if we're not ordering all this stuff from Amazon, we don't, they're not packaging, they're not selling as much of the stuff to ship it to us. Is that part of it? That's what I heard.
Yeah. And again, sooner or later, this will play out in a different environment a year from now. The market will look ahead before you do. And people will start ordering online again, and you'll have missed the current because the market will pick it up for you. Anything you're reading about is already been priced in. Anything you're not reading about is may or may not be priced in, right? And generally speaking, you get a decent momentum trend in any of these super beaten down areas of materials. Just buy the market's trend out of the bottom here, and just say, yeah, international paper's finally going up. Good, I'm in. Take the dividend for a while. They generally pay because they have good cash flows. They get dividends, and you just say, "Yeah, great. I'll wait."
Yeah, I was just looking at the international paper dividend, and it's 5.2% yield.
5.2%. Yeah. Wow. So tell me I'm wrong about international paper. I'll tell you, great. I'll just sit it out. I'll earn a 5% dividend until I'm right. I love things like that, right? I mean, just tell me I'm stupid, and I'll just pick up 5.2. I personally bought some Whirlpool like 6-7 months ago. That 5.5% dividend. Yeah, I get that nobody's going to put in appliances they already have, but they will eventually.
Yeah, for sure.
Yeah, I mean, you say when is a major appliance dealer going to rise again? Whenever the replacement cycle wears itself out.
Right.
Right. I don't need to be a genius about this stuff. I just got to wait it out. And by the way, I get 5% dividend. That's really good. So I just sit, in an income portfolio, your 401k, you just sit on that thing. Yeah. There's dumber ideas in that one.
Yeah, you're right. 4.9% it's now yielding.
Yeah. Whirlpool pays 4.9% right now. So you say, I got it at 5.5%, so it's rallied fixed. I've got 16% return in 6 months because I was right. And then I also got this dividend until it'll roll over again. It'll die again for a little bit. And I'll be fine.
Right. So do you feel the same way about like RVs, like Winnebago and Thor Industries? Because those were in a huge cycle too during the pandemic. Everybody rushed out to buy the Airstreams. Now they're not. So the stocks have, come down, up a bit. Some of them pay dividends too, but not quite as good. I'm looking at Winnebago. It's about 1.6% yield. But is that like a similar thing? I mean, they will... buyers will go back in there to get RVs.
Yeah, I'm a little more concerned about that because, that was, people are going to change and cycle out of it, faddish stuff like RVs at this point. I would say this, though. I wouldn't say it's weak because, housing whenever I look at hotel prices, they're outstandingly high.
Yeah.
And if you have a family, I think the real RV pitch is, if I have a family, I could put the food in the thing, pay $80 a night in a KOA, and I could take my family to national parks for 10 years and stay out of paying for 2 hotel rooms that are $300 a night a piece.
Right.
The economics are so favorable for people who want to do some traveling with families of more than 2 or 3 kids, or they team up with a couple families. I see that a lot in California, or the surfing crowd that puts their equipment together and they kind of get little meetups. So I think a real issue here is, the greed out of the Marriott crowd is going to keep the Thor and Winnebago sales up because people are going to go, hey, I got to Death Valley for $450 a night, or I can go park in Palm Springs and drive over there and check it all out anyways at $100 a night. So what am I going to do, right?
Won't the affordable housing issue also kind of lend itself to the big RVs, not the Airstreams necessarily, but the huge expensive ones? Because a lot of retirees have been swapping out the house for the RV and the open road. That could be a big thing too, as long as affordability remains, bad.
Yeah. These are where people, you can see the affordability thing. I just say, hey, I'll hit the road in my RV. I'll buy a half an acre of land in Wyoming and I'll park it there and go fishing.
Yeah.
I'll get some, and I just say, why do I want to bother with it? I'll go down to the Baja, I'll make it happen. I can be more creative. Like, think about, this is, I think we got to realize, like, we're giving it in with, high speed internet connections and remote working like you and I are doing now. You start saying to yourself, oh, well, I can do this, I can do that. More and more people are realizing that, which then generates more ability to do that with your employer, with yourself, with your spouse, with your community. And people are saying, hey, anything that gives me more mobility with strong internet and voice and video connections to my children, to my grandchildren, to my community, yeah, I'm done. So, yeah, I think, the evolution of these things is continuing. And it's very hard to say, hey, it's going to blow up, right? It's going to end. They're all going to park their RVs now. Really? Because then what are you going to do? Go to Marriott for $350 a night and hang out? No. They're going to get bored. They're going to say, no, I don't want to be bored. I'll keep it,
Yeah. Yeah. All right. There's some good ideas, some good stock ideas as we head into the fall, and we'll see what happens with this rally. We will get a pullback at some point. We always do.
Yeah, we will.
And be some buying opportunities then. Even in these kind of dirt cheap stocks, you'll be able to get them in even cheaper. The Whirlpool is trading at 8 times forward right now too with that dividend. So that's a real cheap stock.
Really cheap stock. I mean, I think we got to tell people, yes, this call for a recession that we do not see does not at all mean we're not bearish and see a 10% correction at these valuations.
Right.
Totally wrong. I could totally, and I'm sure you're with me, 10% correction here, not a problem at all after this big rally. Multi-week rally, haven't seen in 3 decades. Good luck. It's going to roll over and blow up. You get a 10, even 15% correction.
Right.
And so, that's not a recession a moment. It'll create recession articles. It'll get the shorts on the side of the market to write the recession articles. Then we'll have the election come. So then we'll get the right wing pushing, that Biden's blowing up the economy articles. And in half the world will read those things, right? Because that's just what they want to read. So we're going to get them as soon as stock market rolls. We're going to get them, right? And they're not going to be any more accurate than before. Because, again, it's at the end of the day, it's the non-farm payrolls, it's the initial claims on a weekly basis if you want to be a little forward-looking. And it's just saying, hey, that's what it is. Till incomes and jobs dry up, there is no cycle to be worried about.
Okay. We'll leave it there for this podcast. But, of course, we'll have John back on later on in the year, as we always do, and we'll cover all this again and see what's going on in a couple of months as we head towards the end of the year already. Wow, time is flying. So let me recap the stocks we talked about on this show. Let's start with the ETF that John mentioned that it has all the industrials in it. It's AIRR is the ticker for that. I mentioned United Rentals. It's ticker URI. And then the smaller competitor is HRI. Then Mastech, they're also on construction, MTZ. M as in Mary, T as in Tom, Z as in Zoo. And then Tudor Perini, also construction, TPC. Then I just mentioned DR Horton is one of the home builders breaking out. DHI is the ticker. We talked about International Paper with that good dividend, 5.2%. And it's IP, just 2 letters, IP as in Paul. And then we mentioned Winnebago on the RV side. It's WGO, and Whirlpool is what we kind of wrapped up with WHR is the ticker there with the 4.9% yield. So that's a lot going on. And we didn't mention any of the Magnificent Seven really in this podcast, nor did we talk about the banks at all, really. So that's progress. There's other things going on in the economy and investing out there. So you don't want to miss a single episode of the Zacks Market Edge, either on video or on audio. You can get us on Apple Podcasts. You can get us on Spotify. We're on Zacks.com. Click on the podcast link. You can also get us on YouTube now on the video format on our page, which is Zacks.com/YouTube. If you're not already over on YouTube, you can get it. And Zacks Investment Research, just type that in and you'll see us. But be sure to get us somewhere. And I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.